Hi there, and welcome to the latest episode of the NewIn Podcast. I'm Cathi Harrison. Thank you so much for joining us for this episode. And the latest interesting fact I wanted to share is that actually a few nights ago, while myself and the team across Verve and the Foundation were sound asleep, we managed to win not one, not two, but 6 awards, which was just absolutely phenomenal. And fair to say we did a good job celebrating it the next day. So we've got an absolutely jam-packed episode for you. First of all, Hannah is talking to Jo Wall of Joyful Wealth, and she's going to talk about how she's balanced the complexity of regulation with the innovation of actually being able to support a lot more individuals with their advice. And then I spoke to Alisdair from Striver, which is an Australian company. They power our careers and finance platform, and it was just fascinating hearing about all the financial services challenges in Australia and what Striver are doing to help fix some of them. So loads and loads to hear from. Let's dive on in with Hannah and Jo.
So we are here today with the wonderful Jo Wall of Joyful Wealth. How are you doing today, Jo?
I am good. I'm happy. The tax year's finished, so it feels like we survived. We're all good.
Now we're just all in peace. We've all earned it.
I need to cry again, so it's fine. No, I'm joking. I didn't cry at tax year end.
The universe is like, oh, she's done all this stuff in advance. She now has capacity to take that last minute pension contribution. We make it happen. We're all wizards. So thank you so much for joining me today, Jo. We'll jump right in. So tell me your elevator pitch on Joyful Wealth.
Joyful Wealth was born 3 years ago, and I've been in the industry for 13 now. So I love what we do as an industry, as a profession. I think what we do is fantastic, but I was getting really frustrated with the fact that I was a woman in my late 20s, early 30s that couldn't help people her own age, basically, because the majority of them didn't have the money that your average IFA or financial planning practice was able to help. So I thought going down the financial coaching route would be the way to do it. So go down the non-reg route, do all of that kind of stuff. And then the further down the coaching side I went, and at the time it was the year that Consumer Duty was coming in, so there was all this kind of stuff going on. And I just went, actually, there is still a demand for young people for the regulated stuff, but the kind of majority of what they need is non-reg. So there must be a way that we can kind of find a happy medium between the two. So over the summer of 2023, I managed to get my FCA permissions, and I decided that I wanted to do predominantly financial planning in a non-regulated environment as far as financial coaching practices is concerned. So helping people with basic money management, behavioural stuff, the habitual side of money, the educational bit, but then also be able to then, when they did build wealth or were in a position where they, I don't know, moved jobs and needed their pension doing or whatever it might be, that there was still that regulated side. So we effectively split our planning from our products is the best way that we describe it. But we still do all of it. So we are a regulated, authorised practice, but we focus more on making sure that advice can be affordable and accessible for those that might not be able to go to your standard IFA practice.
They do it all up at Joyful Wealth.
We do. Mortgages and protection as well for my sins. But yeah, so it's great because it means that genuinely no two clients are the same and no day is the same.
That is definitely one of the things that I think appeals to a lot of financial planners. So there's a lot of folks that really that variety is really kind of satisfying because you say no two clients, no 2 days are the same, different challenges. So let's go back to the very early days of Jo. Okay. What was it like for you growing up?
I grew up in privilege, and I don't try and shy away from that or avoid that fact. I grew up in Oxfordshire. I went to private school. My parents were doctors. One of the things that both my parents actually said from a very young age is that with privilege, you have a responsibility to share it and spread it, basically. So I was very much kind of brought up with a sense in there is going to be people that are worse off than you, that maybe don't have the opportunities that you have. So acknowledge the fact that you have privilege and that you're lucky and fortunate, but also if you are in a position to help people, then you should. Both my parents are South African. So yes, I was brought up in middle England in a middle class environment and with money, but my family in South Africa were very different. There was lots of money struggles, and we were kind of, the posh cousins from England. And I always found it really interesting where we'd go back and actually most of my family in South Africa had better financial well-being and happiness around stuff than perhaps my parents, even though objectively our family were better off. there was a lot more stress around it. There was a lot more kind of nervousness and angst and that kind of thing. My mum, for example, stresses to no end about money when actually, as a financial planner, she's got financial freedom. She's fine. She's choosing to work rather than needing to. And she's in a really good position to be able to do that. But I kind of think that I was taught quite early the value of money, where just because I had privilege, because I, didn't necessarily want things, didn't mean that my parents didn't make me work for it. And that's kind of what influenced me to join the profession.
I mean, for myself, I live back in Portsmouth now, which is where I grew up, and you've got a real kind of melting pot of people that are the top Navy brass. You've got people that are extremely wealthy business people within quite a small packed island, but you also have people that are very economically deprived, like some of the worst kind of economically deprived parts of the UK. So it's really interesting seeing all those kind of how it stacks. Do you feel like you're quite comfortable around pretty much most people as a result?
Yeah, I would. So my sister and I went to very different schools. I went to a school for neurodivergent children, basically. So it specialised in dyslexia and autism and ADHD and that kind of stuff. And I've always just been really interested in people. I'm always interested in people's stories and interested to understand kind of why they think the way they do. But yeah, my mum said when I was at school, she said to me that she's like, you have a knack with people, and that's not something that's easily taught, so don't turn your back on it. And I really enjoyed doing the numbers and the analytical side of stuff as well. And that's kind of where my interest in wealth management and financial planning came in, because it was like, actually, you can do the nerdy, geeky numbers bit, the kind of analytical stuff, but actually the majority of it is just talking to people about their lives.
That curiosity is really interesting. I mean, it sounds like you had some very astute and really interesting, meaningful conversations with your parents growing up, that kind of exploring your sense of self, especially at 17. I remember like that sense of pressure to go to university, especially if you were able to do academics.
Well, I'm not someone that learns. I think my school was actually really important in terms of like molding the way that I thought about stuff, partly because of the kind of focus on the neurodivergent side of things, but also because it was a Quaker school. The whole Quaker kind of idea is the fact that we are a connected community and everybody has their place in the community. And because of the neurodivergent side of things, they were like, look, the world needs doctors, lawyers, whatevers, but we also need creatives and people to build stuff. And, there is a place for everyone. You've just got to find out what you're good at.
Do you think that kind of like everybody is valuable, everybody is important aside from the school, or your parents had the stronger influence on your decision to kind of try and create this firm that really does try and plug the gap and actually cater to not just this like 9% or whatever it is of people that currently access financial planning?
And my parents were very, they actually put a lot of our friends, like their friends' kids, off being doctors and stuff like that, because they basically said the school will tell you to go and do medicine because you're intelligent and you've got the A's and A stars in the right subjects and whatever, and it's the prestige of being a doctor. But actually it is a life choice to be a doctor, because it is a really difficult career as far as the hours and the work and the time that you have to put into it, but also you have to want to help people. It's not enough to be intelligent. If you want to be medically intelligent, go and do scientific research and pharmaceuticals and things like that. But if you want to actually be direct to patient, you need to actually give a shit about the patient in front of you. Excuse my French, sorry. But, you have to care about the people that you're treating, basically. So that was kind of on the one side. And then that was kind of reinforced by the school's ethos of kind of going, we all have a place, we all need to look after each other. It's not about the individual, it's about the community, and it's about everybody working together and playing to their strengths.
No, that's honestly so fascinating, Jo. And yeah, it all sort of stacks together in a really interesting kind of mosaic way. So moving forward then, in terms of then those first steps into your career, you said it took you a little while to kind of find your feet in things. So what was your first entry point, and how did that then develop to the point where you were considering setting up Joyful Wealth?
I guess it was kind of a combination of things that all kind of sort of happened at once. So I left school not really knowing what I wanted to do, but kind of knowing that I didn't want to go down the academic university route. Long story short, I ended up moving to Cardiff, which is where my sister was at university. So I got a job working for Barclays in their consumer credit arm, just doing customer service and complaint handling. My boyfriend at the time then got a teaching job in Surrey, so we moved to Surrey. And at that point I went, well, I need to find a new job. And there was a mortgage brokerage that were taking you on and that basically would train you up and do everything from scratch. And the only requirement was a C in maths and English at GCSE, and that's it. you know, it feels like the first proper kind of entry into the world of wealth. And, you know, I loved the fact that I was able to build these really good relationships with my clients. But the thing that bugged me was I knew that some of them had inheritance tax issues and some of them potentially would have capital gains tax issues. And I had the kind of awareness of it, but I kind of just felt like I was like, oh, I can't quite do everything that I want to be able to do. And that really frustrated me. And long story short, we kind of went, right, well, I kind of want to get into the world of wealth. I know that I now need to go and do my diploma and that kind of stuff. So I then started power planning for an SJP practice, just because it was like, I just needed a job. It was like a whole new area. I was like, I need to get in. So I managed to get my CII diploma done in less than 9 months. And then I joined a very large firm up in the Northwest called Equilibrium. And I had so much exposure. I learned so much. I got chartered and fellow in the time that I was with them. I was around like the most incredible wealth of knowledge as far as how planning should be done, both in terms of like the detailed technical knowledge. And it was just, yeah, it was the exposure I got. It was like the steepest learning curve I think I've ever had in my life. I was working towards CAS. I was working towards, obviously Consumer Duty was due to come in. And I kind of, the more and more I was doing it, the more I was going, this isn't what I want to be doing long term. Like, as much as I love what the company did and the client outcomes, you can't fault them. Like, I still don't want to be dealing with 50, 60-year-olds that have got $500,000 in their pensions. I want to be helping people like me. You know, all my friends would kind of go, oh, I don't really understand this thing. Can you help me? My pay slips, like my pay's changed. I don't really understand it. And I don't really know how to read my pay slip. I don't really understand it. Or my company's telling us that we can now take advantage of salary sacrifice. I don't understand it. I don't know if it's the right thing. And I'd kind of go, well, I can explain it objectively to you, but I can't really help you and advise you. And all this time, you've then got the kind of wider profession being like, we should help people. We should do this. We should help younger people and da-da-da. But, you know, it's too difficult, it's too costly, it's too whatever. And I'm kind of sat there going, I don't actually think it is. Just because they've not got, you know, quarter of a million, $500,000 in their pension pot doesn't mean that they can't benefit from advice. It just means that you're going to kind of catch them earlier and do some of the more basic stuff with them. And there's definitely a way that you can make that affordable, because you don't actually have to do the regulated fact find, attitude to risk, recommendation. It's more kind of an educational bit, which is where I then thought, oh, well, I'll go down the coaching route, because that feels like a happy way to do it. But then the more coaches I spoke to, like, the coaches kind of would get people to a certain point and then go, I've built their confidence, I've built their knowledge, I've built their experience, but they're now at a point where they've kind of hit their ceiling of what they're comfortable doing themselves, but there's no one really willing or able to help them. Or if they are, it's extortionate for the value of, you know, for the size pot that they've got. And then you had planners kind of going, we really want to help these people, but we kind of do it for free. We kind of do it as a bit of a one-off, and then we see it as maybe if we give them a bit of help now, they might turn into a client later on. And it was kind of, there was just this like little kind of pinch point in the middle. And I sort of went, I think there's a way that you can combine the two of them. You've just got to find the sweet spot with it. I'm not saying I found the sweet spot, but I found a sweet spot. So I left Equilibrium at the end of February 2023, and I kind of went, I'm going to do my Wise Monkey financial coaching course. I know I want to set up and do something, but I think I'd started my coaching course and then I had one more exam to get to fellow, and I sort of went, it feels like a little bit of a waste of all that time and all of those exams to then just completely turn my back on the regulated side. Also, I was kind of looking at that sort of regulated, non-regulated boundary, and I kind of was like, yeah, that line is really difficult and it's so easy to cross that actually there is a real risk of someone, based on my knowledge and experience, I was like, I've got a real risk of, if I'm not regulated. I was very aware that it was very easy for me to cross into a world that I shouldn't be crossing into if I didn't have permissions. And that's when I kind of sat down and went, okay, I need to be regulated then. And that's why now I'm such a big advocate of the Verve Foundation Consider program, because I'm like, oh my God, I was totally unprepared. So the business has been a concept for 3 years, but we've only really actually been seeing clients, or I've only really been seeing clients since the kind of September of 2023.
That's brilliant, and also very, very interesting. So was it the Consider program that kind of helped with the epiphany?
It was kind of, you set up the business, but you don't know what you don't know as far as the regulatory bit was concerned.
Yeah.
At the time, there were loads of business coaches, even financial planning business coaches, that were like, this is how you set up a business and this is how you do that. And you go, that's all great. What about regulation? Because I know regulation, but I don't know business owner compliance regulation. I've never had to think about financial promotions before because that wasn't something that I had to deal with as an employed person. We got given suitability report templates, so I kind of knew what was included, but I've never had to be the one making that decision. So it was the lovely Tina Weeks, actually, that I'd reached out to and kind of went, I really like what you're doing, can we have a chat? And I was talking to her about what I was doing. And she was one of the mentors at the time, and she said, you need to speak to the foundation because it might be really useful for you. So thank you, Tina. It was the best thing you've ever done, best thing ever that happened in my journey. What was really nice was meeting like-minded people in terms of setting up businesses, very much early stages. And I remember the session we did with Maddie, who's Verve's head of compliance, and she said, run your business like it's a DA, regardless of whether you're an RI, an AR or whatever, it doesn't matter. You still need to make sure that you're on it. And actually that was, again, one of the best pieces of advice, because you go, okay, I know I need to worry about these things, even though I've got some network over the top of me, it's still my responsibility. And that was really nice, because then she went, and these are all the things that you need to be thinking about. You go, okay, cool. I've now got a massive checklist and to-do list of things that I need to be making sure that they've either got the policy for and I know what the policy is. And if they don't, then I've got my own policy or my own process or my own whatever. I definitely feel that having done the incubator program, it's made me more of a kind of business owner rather than just someone figuring it out.
Yeah, and it's honestly, I think probably some folks that I've spoken to who have been long established business owners of their own practices, there has been a little bit of kind of envy when you talk to them about the project, because it's like a lot of folks within financial services became a business owner completely by accident. I remember a brilliant client I was introduced to at my old firm who was an expert in installing refrigeration systems, and chatting to him in our meetings was really fascinating, because he never expected it to get this big. He never expected to be this successful. He wasn't like this hustle culture entrepreneur type dude. He was just a guy who was not very good at something. And I think one of the real benefits of that program is indeed that it just kind of opens your own mind and it teaches you some of your unknown unknowns, and it puts you in that, but it puts you in a position where you're actually like, okay, this is a long checklist, but it's also a checklist that I now have, and I have that knowledge and can I have that understanding. So as you say, I think behaving in such a manner that you're sort of doing it, I guess, big girl style, rather than just sort of hashing
it out. That's exactly it. Actually, I think by doing the program, it sort of, not that I needed permission, but it sort of gave me the permission that I was looking for to go, no, if you're going to do this, you need to do it properly, and therefore you need to have that business owner mindset. And there's this kind of, going back to your thing about, accidental business owners and stuff, is like, are you a financial planner that happens to own a business, or are you a business owner that happens to be a financial planner? Because the two mindsets are very different.
I think that is one of the beautiful things about having so much control and being in the position you are now with Joyful Wealth, is that you are able to realize all these different things and these kind of aspirations. And so obviously you have such a unique proposition compared to the majority of wealth firms who, are driving by assets under management, percentage basis charging. Without wanting to go too much into the depth of your secret sauce, what would you say the core principles are for folks that are looking to set up a similar way of servicing clients to the one that you've opted for?
Understand where the regulatory boundary is. And I get that the FCA sometimes disagree about where that boundary is, so it's not necessarily simple, but there are lots of things that as advisors we provide under our ongoing advice fee that you don't necessarily have to have the regulation behind you to be able to do. So part of the financial coaching side is education, is just, this is what an ISA is, this is what a pension is, this is the trade-off between the two, conscious decision making, having goals. I also do a lot around financial well-being, things like being in control of your finances, having a plan, knowing what your options are. I would say that really understand what are the COBS rules and the regulatory bits that we have to do, and go, well, actually, I can still do that as a side, obviously regulation is there for a reason, it protects everybody, but actually there is so much other stuff that we do as financial advisors and planners that we don't actually have to follow the prescriptive regulatory process to be able to provide value to clients in. So tax calculations, cash flow, all of that kind of stuff is not regulated. Yes, okay, fine, you still need to have an understanding and you've got to be really careful about making recommendations, but presenting someone with their options and going, these are things that you could do, is still possible, providing you word it correctly and you're careful with how you present those options.
And I think it's interesting because you talked a lot about kind of perceiving that business risk of the kind of, the blurry line that the regulator and the government keep trying to give us, this line of like, no, this is advice, this is guidance, this is, and obviously they're now coming out with their new projects that will apparently fix all of our ills.
The profession is shifting, regulation is shifting. What clients need from us as professionals is changing. And I'm really excited to be able to help be a part of that positive shift, because we do things very differently. Like, we don't have a minimum asset level or a minimum fee necessarily, because we have this lovely way of being able to charge for financial planning completely separate to the assets. So it means that if you are a young person that needs accountability, education, some tax calcs doing, the kind of some of that side of the tax planning and financial planning side, we can do that on the basis that you've probably got a workplace pension that's doing exactly what you need it to. And if you've got a bit of spare cash, we can help you work out whether you overpay your mortgage, spend it on a nice holiday or yourself, maybe repay some debts if you're in, got a bit of personal debt, whatever, or we set up an ISA and we start investing it and we do that kind of stuff. But also making sure that we've still got recurring revenue, it's fair, it's, affordable, that kind of stuff. And we do have some classic kind of standard, financial planning clients that have got however much in their pensions that we manage, and we see them, once a year, all that kind of stuff. But it also means that the majority of my retirement clients are civil service, forces pensions, where they don't have money for us to manage, but they still need the retirement plan. But it's not transactional. It's not just here's the plan, see you later. It's, okay, well, here are your pension options. This is the amount of tax free you can get. This is the best way to take your pension income. This is how we can structure your lump sum and invest it and do whatever. But we can help you navigate that transition from working to retirement to, maybe having a gifting and inheritance tax strategy, but we're not actually necessarily managing any money for them, but we've still got the strategy and the plans. So I often get feedback from other advisors saying that I don't charge enough for my financial planning fees. And I'll kind of counter it and go, yeah, but what do you think I'm doing for that financial planning? Because actually we charge a separate fee for wealth management, is what we refer to it as our services for the product-based advice, because we have to go through the fact find, risk profile, this, that and the other. I might still do that with a financial planning client, but it will be an educational tool rather than it being a prescriptive requirement. And so it's a bit more free flowing, which means that meeting prep is much lower, post meeting stuff is a lot lower. Yes, okay, fine, you might need to gather a lot of information for, a tax calculation, for example, but that's not regulated. So you can charge less for it. The way that I work it out is loosely based on an hourly rate, and then however many meetings I need per year, divide that over a 12-month period, and then you go, right, that's your monthly fee. I feel like we're just getting started. We're just gathering momentum. We've proven the concept. Regulation and the FCA are kind of on our side as far as what we're doing being a good way going forward. For me, it's about impact. I want to be able to be as impactful as possible. And there's this whole kind of quality quantity debate of, you can either help less people more deeply, or you can help more people but maybe less deep. And for me, I would, because there's so much simplicity in some of the planning stuff that I do, I genuinely feel that there are ways that we can help loads of people, even if it's a bit more maybe surface level and not as deep as perhaps we'd like. And that's kind of where I'm focusing on, is going, how can we help as many people as possible? but still keep it so that it's that kind of, they feel the depth of it. And you'll know this as part of the foundation, is I will always give my time to people that are wanting to do similar things, or that are wanting to kind of understand how we can serve clients better. Because just like I reached out to people when I was early stages of going, well, you're 3 years ahead of me, how have you found the last 3 years? If I can give back, that means that I'm helping them, which means that hopefully they've got more headspace and time to then help their clients, and it all just cascades out. So I very much see my kind of 9% of adults in the UK get professional advice. That number has got to increase.
Yeah, brilliant. Right, Jo, I think we could probably talk for the next 6 weeks about all of the ideas and thoughts and feelings we both have about financial planning. It's been such a pleasure speaking with you. Thank you so much for all of your story and your knowledge and your wisdom. And we wish you all the best of success for the next however many years it is, the Joyful Wealth, the life project that you've got.
NewIn Podcast, supported by Royal London, the lead sponsor of the Verve Foundation.
Welcome to the NewIn Podcast. For this episode, I'm absolutely delighted to welcome Alisdair Barr from Striver. Thanks for joining us.
Thank you for having me, Cathi.
Just tell us a bit about your background and then a bit about Striver and what that does in financial services in Australia.
Yeah, so I've been in financial services since 2000. And I started working in a small financial advice firm here in Western Australia, where I grew up, and then spent about a year here, and then quickly wanted to get to the East Coast. I went to Sydney and then started working in small advice firms and just kind of learning the ropes as a paraplanner and working around small businesses. And I ended up going and working in a large bank in Australia, which I wasn't really that keen on doing. I was only going to go there for 6 months, but I ended up spending 9.5 years there, and which was great. I worked in built distribution channels and franchise businesses for the bank and all around advice. But you either become a 40-year career banker or you get 10-year itch and you leave. And that's what I did, and went off to sort of change the world or leave a footprint in the world. And I did that around financial literacy. That was my sort of social enterprise, and went off and worked on that for a while. But that was always a bit more social than enterprising. And so I had a whole bunch of clients that I knew, advice firms that I'd worked with through the bank, who were looking for talent, and the business that I ran at the bank grew a lot of talent. And so I ended up started connecting university students with advice firms to sort of, put some pennies on the table, really. And then, the business kind of evolved out of that. And so Striver was kind of born out of what I learned through a corporate world and getting into my career probably in a non-linear way. And then, through the network, being able to help lots and lots of new entrants find great advice firms to kickstart their career. And so we've really sort of positioned ourselves right in the middle about, the gateway for the new generation of advisors to come into the profession.
Amazing, thank you. And yeah, we'll definitely pick up on some of those challenges, and as you say, the similarities between what you're experiencing over there to what we have in the UK. Just to go back a bit about the market in Australia now, what does kind of the demographic look like? What does the supply and demand issues look like? Are the supply and demand issues? Do you need more people to be coming into finance? And if so, what are the challenges? What's the stuff that's stopping it from happening?
I don't know if we've got enough time, Cathi, but I think the thing that's different here than there is the education framework that's required. There was a change in the education standards, which really made it very difficult for new entrants to come into the profession unless they went back and studied a full-blown financial planning degree 3 years at an undergraduate or postgraduate level. Right. And that came in several years ago, and that really, it just made it difficult for career changes. The profession used to find teachers and nurses and engineers and people who would come with certain skills, and they would do some more education, but they didn't have to go and do like full university education. We also had 4 big banks and AMP, which is a large super fund, that all hired 1,000 advisors a year, and they would train and develop them, and ultimately they'd leave because they were large organisations who struggled with turnover. And then, if you got 20% or 10% turnover every year, you've got 500 or 1,000 IFAs leaving banks to set up their own shingle, right? So this was the lineage of how our financial advice profession was built. All the banks left, they stopped delivering advice. So there hasn't been that breeding ground of talent. And then we've got an aging demographic of the average financial advisor in Australia is 55-year-old one-person advice business. And so, yeah, it's like a perfect storm, right?
Is that still the case in terms of the education? Then you still need to go and study like a degree level financial planning qualification?
Some legislation that's yet to be passed later this year that it will come back to a relevant degree. So you could do an accounting degree, and then you must have studied some finance units and then some financial planning related units. But you can come back and get those on top of your core university degree, but it must be delivered at university or higher level qualifications. Somebody who's got a nursing degree or something like that can come in and can do, a handful of units by correspondence through a university to get their ticket.
We went through something similar, but not as extreme. So I was in 2012, and it went from advisors needing a level 3 sort of qualification to a level 4 like diploma. But our degrees are like level 6 to 7 normally. So your diploma is lower. You could have done a degree in hairdressing or marketing or whatever, but that's irrelevant. You still need to do this, the actual level 4 diploma. Or you could have no degree and you could come fresh out of school and kind of go and do it. And at the time, that was seen as like a big leap up. And there was a lot of advisors who'd been advising for 40 years and didn't want to do those qualifications, so just left anyway. But level 4 felt like a good enough level to go, there needs to be some commitment to the education. I can't imagine the challenges here if they tried to make that like a level 6 or a degree level, because, even with the level 4, and even when it's one of the reasons we founded the New Talent programmes, because we then fund that qualification. So if you are a nurse or a teacher and you want to career change, but you can't afford the time out or the studying or the cost of all the books, we'll cover those costs. And even with that, it's hard, people doing the studying alongside the job and then trying to find an entry-level role. And as you say, that you still need to take a step back because experience-wise, you're not at the same level you were at. So it's already really hard taking that up another level as well. I don't know that we'd get anybody into finance.
Well, the other thing they did was, which I think it's good that we introduced a professional year, right? So for the first half of that, the individual might be billable. So there's a full year, and so they must be supervised. They must do a certain amount of ongoing education for that first year, and before they can get their full ticket to become an advisor again. So again, like small businesses who are funding that, fund the training, fund the development, and then they move down the road for another 20,000. I don't like always talking about the doom and gloom. There's lots of positives and green shoots, and it's really magical and it's great and exciting. And I think about the future, but that's kind of where we went from 26,000 advisors to 15,000 advisors over a period of 5 years, right? So that's we're 60%, and so. And, there's 11.9 million Australians that need advice and are prepared to pay for it or prepared to pay something for it. And there's only capacity in the system to service 1.9 million of them. There's 10 million Australians that are saying, well, where do I get advice from?
Yeah.
Glaring opportunity.
Well, this is it. Yeah, it sounds doom and gloom, but actually, yeah, it's a huge amount of opportunities. Talk to me a little bit about Striver's position in all of this and what the particular areas that gaps that you're trying to fill.
Yeah, so we traditionally built ourselves as a graduate recruitment business, really, and so we'd be low cost, at scale, and jump up and down and rant and rave at universities about what a great career advice is, and then take people on a journey and get your feet on the desk. It might be a 3-4 year journey before you're sitting in front of a client, but we need you, and it's a great place to work. And then we built software, which was like turning into a matching platform. We used to run them through speed networking events. That's how we built the business, and we digitize that. So now candidates come through. We now have, speech-to-speech AI conversations with them, and then humans intervene, and then we showcase them on a platform. Basically make the decision-making easy, quick and simple for an advice firm, but also make sure that, the candidates you can find and have good conversations with good people and ultimately get jobs. And then we partnered with a bunch of, product providers in Australia who then kind of are really passionate about the next generation of advisors and seeing advice numbers grow. And so they all partner with us through education and content and events and so forth. And through that process, we said that Strava wants to support 5,000 new advisors over the next 10 years, whether we're getting them jobs or we're just being part of their story or part of their journey or in making the right introductions. 5,000 new advisors, 1 million Australians getting advice that they want access to.
I guess you're saying there that, yes, one of the ways you need to get the numbers back up, some of it's through humans, some of it is going to be through tech, some of it is through innovation in the way that advice is delivered. So one of the advisors that we spoke to in this episode, she's gone for a subscription model rather than charging a fee based on the value of somebody's assets. Do you think kind of more, I guess, business structures or charging styles might be another one of those ways that can kind of help to close that gap of 10 million people?
Yeah, I think we've always struggled with like the delivery costs of advice, compliance costs and so forth. But, you know, sometimes people just want you to help them with one particular problem they have right there, right now. And so the advice model here is to push them into a full ongoing advice model and charge them $5,000 a year or whatever the number is. And so I think that sort of coaching model or subscription model or single advice when it's needed model on top of that is a way that you can sort of deliver more efficient and effective advice when it's needed. Like I think, you know, I said 10 million Australians need advice. They're not going to pay $10,000 a year for full advice because they don't need that. They need something and they need it now. Yeah. And I think the trick with that is just being able to give people advice and a price point that you can deliver en masse to. And so I think that's going to be the win out of the technology and the AI. I think not bolting AI into complex laggard systems, but just thinking complete white sheet of paper. How do I deliver this piece of advice to that person when they need it? Or how do I get them, you know, into a subscription model where we can make some money, but we can also deliver great service?
I presume it's the same over there as it is here, where even if they're the questions that advisors are asking themselves, it's that balance, isn't it, between the compliance and the regulation side of it and making sure that they're still kind of demonstrating all of that, but doing a different model. Are you seeing that there is much appetite over there for kind of trying to find your way through like these more innovative models and these more transactional based or subscription based, despite kind of the regulatory pressures that can limit it?
Look, I think because there's such a demand supply exercise, financial advisors can do very well in the market at the moment in Australia. So, and the way it's always been done. Because we don't have another 5,000 people rolling in. And so there's a bit of like supply demand economics that's meaning people aren't sort of starting again. Like there's obviously technology coming in. If people can come in with a white sheet of paper and start from the beginning, I think there's some really, really cool things happening. And there's some really innovative advice bits. And there are businesses that can deliver, or there will be business models that can deliver advice at scale to that group of 10 million Australians who won't pay 10, but they'll pay more than 500. But I think trying to take traditional business models and tech them into low cost delivery, I think it's just we're not seeing it work fast enough.
You said you left your last job because you wanted to go and kind of put your stamp on things and make your mark. Do you feel like you've done that yet, or is there more that you want to do?
There's a bit more to do. Come and work with you, Cathi. No, I think there's a lot more to do, and I think I mean I've been in this profession for 25 years, and so I feel like I grew up in it, and I learned a lot, and I've enjoyed it. I've seen the impact it makes to people, and I think that as professionals we should replace ourselves plus one, and so if I can do that with a little bit more scale and replace it with 5,000, then that's a really good thing to leave. So
I love that though. I love that concept of like if everybody took the approach of replace myself plus one, like what a difference it would make like over time, that accumulation. So going for replace yourself plus 5,000 is quite punchy, but I like it. I like ambition.
Gone a bit harder.
Fair. Thank you so much for joining today and chatting a little bit about all the good work that you are doing over in Australia, but B, for partnering with us on our Careers in Finance platform. And I feel like we haven't even scratched the surface of the stuff that we want to do to help bring people into finance and help them find jobs. But we've made a start thanks to Striver. So thank you very, very much for that. I really appreciate it.
You're very welcome. It's very exciting to be working with you, Cathi.
No worries at all. And thank you very much to everybody for listening and watching along to today's episode. It's our final main episode from the first series, although we do have a little wrap up, episode 11. That will be coming very shortly, where we'll be looking back on some of the main things that we've all learned and taken from series 1. So a huge thank you for everybody being involved in today's episode. Thanks to Ali. Tune in for the very, very final episode of series 1 soon. Thank you.
If you're interested in joining one of our advisor programmes or being a supporter of our mission, then head on over to vervefoundation.co.uk.